Well, I think it's certainly true that, back in what you said was the golden days, wealthy people paid a much lower effective rate, but it was still, much higher than it is now. And so I think, even a 5 or 6 point difference is nothing to sneeze at. Even if we brought it back to those levels, that would raise a tremendous amount of money, like $2 trillion over the next 10 years. So that's nothing to sneeze at. But I think it does speak to the issue that the top marginal rate is just one piece of this whole puzzle. And we need to be thinking more holistically about the tax code and the ways wealthy people avoid it through capital gains and also through tax avoidance, which I think speaks to the fact that we've disinvested in the IRS in recent years.
Well, tax avoidance, I mean, that would be taken care of with the top rate that you're paying.
Well, it doesn't. I mean, so if there's a capital gains rate that's much lower, and back in those days, the capital gains rate was 25%. It's about that now. You can, wealthy people create tax shelters to basically convert their income, ordinary income, into capital gains, even if it's labor income or regular income. And today, there's even more loopholes. You have the capital gains loophole. You have this new pass-through business deduction, which allows wealthy people to pay a lower tax rate, even than the top rate, which is now 37%.
Robert, what do you know about that?
Well, look, this is the big question with all these proposals. If you go to a 70% marginal rate, do you include capital gains or not? And there is a huge difference in what you collect and how it's treated. If it's just ordinary income, you collect a lot of money. Yeah. If it includes capital gains, to the guest point, there is so much avoidance and timing that the wealthy can just shift everything to a different year. So you actually raise a lot less if you include capital gains on that. And, of course, none of these proposals have gotten that specific yet.
Right.
Yeah.
Alex, how do you weigh in on this?
Well, I would agree with Seth's point, the point earlier, that tax avoidance is a huge problem. I wouldn't refer to those provisions as tax loopholes myself. I think we tax capital gains at a lower rate because we want to encourage capital accumulation to grow the economy. But it's definitely the case that as the rates go up, that people get more and more and more creative in terms of how they report their income. There are really two effects here that matter. One is a real economic effect, which is high marginal tax rates discourage entrepreneurship. They discourage innovation, and economists only debate the magnitude of that effect. They don't debate that effect. And then the second is the point that was mentioned earlier, that people find ways of reporting less income. So it might actually look like this policy is working because we'll see incomes for high-income individuals fall. But really what we're doing is we're just encouraging them to hire attorneys and accountants to come up with new schemes.
What's the way to fix that? What would you say, Seth?
So I think, the main, one of the main problems with the tax code, what some people call the Achilles heel, is the ability of people to defer realization of capital gains, sometimes indefinitely, so basically avoiding capital gains taxes forever. And I think we really need to look at the base of the capital gains tax. Senator Wyden, who's the top Democrat on the Finance Committee, talked about looking at a mark-to-market system. But we really need to look at patching up the base of the capital gains tax so that people can't avoid it.